Welcome to our one-hour webcast titled, What Finance Leaders Need to Know About Expanding Operations Overseas, brought to you by CFO Publishing and by the sponsor of our webcast, Nair Co. I'm Joe Fleischer, and I will be your moderator today. Now, before we begin, what I'd like to take the opportunity to do is introduce our very distinguished guest speakers for our webcast. They are Dr. Sean Nair, co-founder of Nair Co., and Ken Goldman, Executive Vice President and Chief Financial Officer with Black Duck Software. And by way of background, Dr. Sean Nair is an expert in international expansion who has grown Nair Co. from a small services firm to a global enterprise with offices in the United Kingdom, India, China, the U.S., Japan, and Singapore. And under his leadership, Nair Co. runs more than 4,000 client operations in more than 50 countries, providing tax, human resources, compliance, and legal support to offices of multinational companies throughout the world. And Dr. Nair oversees the company's business strategy with an emphasis on client care, new business development, and the proactive use of technology to secure business advantage. And indeed, Nair Co. has been recognized for its excellence in client service, named a top 100 outsourcing service provider in the world by the International Association of Outsourcing Professionals. I also want to add that Dr. Sean Nair himself is a highly sought-after speaker on globalization and a contributing author for various publications. He has been interviewed and quoted by CFO Magazine and other leading publications on international business expansion issues. Also, wanted to let you know that we will have additional perspective, CFO's perspective, during our webcast from Ken Goldman. I mentioned he is the Executive Vice President and Chief Financial Officer with Black Duck Software. And to Black Duck Software, Ken brings more than 30 years of financial and operational experience. Before joining Black Duck, Ken was Senior Vice President and Chief Financial Officer of Salary.com, a company that he took public in 2007, and he's also been named CFO of the Year by the Boston Business Journal as recently as 2009. What I would now like to do is introduce our very first speaker, once again, Dr. Sean Nair. Please give a warm welcome to him. Thank you very much.
Thank you very much, Joe. Ladies and gentlemen, good morning if you're in California, good afternoon if you're on the east coast of the U.S., and good evening if you're in Europe or further east. In this presentation, I'm going to cover 5 basic points, and I'm going to cover them fairly quickly with a view to perhaps taking questions for the detail afterwards. I'm going to look at the kind of issues that you need to get right if you're going to strike the right balance between cost and risk when you set up your foreign operations for the first time. I'm going to look at how you manage your employment risks. I'm also going to look at additional, more recent current-day concerns that are more topical that you need to worry about. And I'm also going to look at mature operations, how you would repatriate profits that would have built up over several years. Last but not least, I'm going to just touch base on the personal liabilities that you would be taking on when you agree to be a director of a foreign company. So let's move on to the next slide. Striking the right balance between cost and risk. I've listed here basically the 4 levels of infrastructure that you would consider when you first attempt to enter a new country. The lowest level and the easiest level, but a risky level, is to employ contractors who are not really contractors, who basically fail the classic test of self-employment. But through their engagement, you avoid having to set up any form of entity or registration in that country. A contractor arrangement is risky, but it may be fine for a short period of time, particularly in countries like Hong Kong and Singapore. But if they continue for a long period of time, you run 2 basic risks. There is the tax gross-up risk, which while initially small, could increase in that the tax authorities could, through an investigation of the tax return of the contractor, come back to you and deem that this person was actually your employee and therefore treat the amounts that you pay them as net and gross up. That actually is not a very high risk in the short term, but obviously if you have contractors for periods of 1, 2, 3, 4 years, it's an increasing potential concern. The Other and more serious concern with contractors is region dependent and principally arises in Europe, where there is the concept of deemed employment. So, in other words, the contractor may accept a contract from you, but if he can show that his relationship with you was very much in the nature of an employee with an employer, and if he can also show that he was terminated in a manner that was not consistent with employment law, even if it was consistent with the terms of the contract, he would be able to establish a case against you in an industrial tribunal. Industrial tribunals in most of the European countries at the basic level are generally in favor of the employee, and you're guilty unless you can show yourself innocent. Although often on appeal, decisions are reversed and you get a more fair decision, but you would be setting yourself up to go through a load of hassle through a contractor arrangement when you thought that was the easiest way to enter. So contractors are okay for a short time, but beware of letting that type of arrangement just continue through inaction. The second level of infrastructure is to set up what is known as a place of business, a representation office, a liaison office. They have different names in different countries. In some countries like Spain and Russia and China, these types of registrations are taxable, but generally the main advantage is that they are not taxable. Therefore, there is no requirement to keep accounts and to file any accounts at the year end, although they are a useful vehicle for getting payroll and social security registrations so that now you can formally acknowledge your relationship with the foreign employees as employees, and you can basically withhold, issue pay slips, pay over taxes and social security. There is, though, one issue that you need to be careful about. Often, when you set up a place of business, there will be paperwork that is required that will list the type of activities that the place of business is going to undertake. These activities need to be non-core activities of your business, and the job titles and job descriptions of your employees need to be consistent with that, as does their seniority level. So you cannot have a senior level person in a place of business. More to the point, often if your paperwork states that some of the activities in your place of business are activities that impact on the IP that you're developing. For example, if you have a telecoms product and your paperwork says that the place of business you're setting up in Germany is aimed at finding out what kind of customization the local potential customers would require for your product, that could in future years when your operation has matured be deemed to be in some way a local input into the generation of your IP, which could lead to a demand for some of your IP revenues to be booked in that particular country, in this case Germany in this example. So be careful and think ahead as to how your operations are going to expand and what kind of risks you could incur then through the device of setting up a simple place of business registration now. The one level above a place of business is a branch. It's known as a branch in many countries. In the UK, it's known as a taxable establishment. But it's basically a taxable place of business. The main risk of that type of registration is that the company of which the local country is a branch will be running a progressively increasing permanent establishment risk, a risk, i.e., of being taxed in that country. So if you had a U.S. company with a UK permanent establishment that's taxable, the U.S. company would progressively over time run an increased risk of being taxable in the UK on profits that it makes from UK activities, even if these revenues were being booked in the US. The extent of that type of risk will vary with country. The risks are very high in countries like India. They're relatively low in some of the European countries. But a good way of dealing with it is to put a blocker company in between. So in other words, to put for example, a Shell US International Holdco in between and set up the foreign company as a branch, foreign operation as a branch. You also need to be aware that in certain countries like the UK, there is a legal requirement for the entity of which the UK is a permanent establishment to file accounts in UK Companies House. And once these accounts are filed there, they're in the public domain. So again, that would be a very powerful reason for putting a blocker company. The highest level of infrastructure is, of course, a subsidiary. subsidiary is great in one way, in one or two ways. Your customers realize that you have a strong commitment to that market. Your employees realize the same, so you may get better quality applications. But in the event that the venture does not work, the costs of shutdown and pullout are significant and can vary quite substantially between countries. The next slide basically looks at how you would manage your employment risks. The very first thing you should do before you even enter into negotiations with prospective employees is to know two things. What are the going rates of remuneration, and what are the mandatory benefits that apply to the type and grade of person that you're planning to hire? Certain countries like Italy, Spain, Portugal, and Brazil have what are known as collective bargaining agreements, which the unions agree with the authorities and apply nationally. So that even if, say France has a minimum wage, a collective bargaining agreement for a particular grade of person would require a minimum salary that is in excess of that, and would also require certain minimum benefits to be provided. And these constitute the floor, a floor on what you would offer. Market conditions would normally dictate that you would offer more than the floor, but it's important that you know what that floor is. The floor will also depend not just on the collective bargaining agreement, which in turn is dependent on the industry sector that your business falls in, but it's also dependent on the seniority level. And often the seniority level of the person could also dictate whether or not overtime regulations apply, directly, indirectly, or not at all. Some countries also have the concept of 13th and 14th month salaries, and it's very important that the offer letter covers this point so that you don't suddenly face a demand in June and December for an extra month's salary that you hadn't budgeted for. You should also be very careful about knowing what your rights are and what rights you want to preserve, because if you don't preserve them in your initial offer letter to the employee-to-be, you will have lost them by default. And particularly useful rights are the rights to put the employee on probation, the right to pay in lieu of notice, and the right to put an employee on what the British call garden leave, i.e. sit at home and do nothing while we pay you. Non-competes, as you know, are difficult to enforce in Europe and are overridden by European human rights legislation, which dictates that an individual has an absolute right to find a living for themselves, and nothing that they sign up to can interfere with it. The danger with a non-compete is that if the judge strikes it down, the entire non-compete is gone. An alternative way around it, and these are all the things that you should be discussing and thinking about before you even enter the country, an alternative way around it would be to have a combination of a long notice period, like 6 months, and a garden leave provision. So the guy is basically employed by you, but he's asked to sit at home and do nothing. You have to pay him the full salary, but you've blocked him out of the market. And in 6 months, his knowledge of your technology may have become a little bit aged and obsolete. Another decision you need to make is whether you want to have just an employment agreement or a staff manual. Generally speaking, I would recommend a staff manual, which in American speak is employee handbook, if you are going to have more than 4 or 5 people in a country. Because the advantage then is that you get the employees to sign on to the staff manual when they join. The staff manual will have sections on it that cover issues such as disciplinary procedures and grievance procedures. And thereafter, therefore, if you end up in an industrial tribunal or an employment court, the employee will not be able to have the court review the procedures for their adequacy because he will have signed on to them at the start. The court will simply look at whether you operated the procedures in an objective and fair manner. So one step in a 2-step process is eliminated. The risk with an employment court being naturally biased in favor of the employee is significantly reduced. The next slide, which I'm just going to push, covers some additional current day concerns that really come from either changes in regulation or changes in regulatory practice. The UK has always had health and safety regulations, but 2 to 3 years ago, the concept of corporate manslaughter was introduced, whereby if somebody dies or is seriously injured on your premises, and you don't have adequate health and safety regulations in place that meet a defined minimum standard, the directors of the UK company can be held to be liable and criminally liable, including being liable for prison terms. It is possible to get insurance to cover the legal costs, but it is an important matter to be aware of because although these rules have been around for the last 2 to 3 years, they are being enforced with a greater level of regularity these days. India introduced an e-waste policy on the 1st of May of this year. It took effect on the 1st of May of this year. And again, if you have operations in India where you are using a lot of servers and PCs and whatnot, dealing with that waste in an environmentally friendly and preset way is very important now, whereas it wasn't the case before. We're all aware of the FCPA and the anti-bribery policies and practices that US companies are required to have in place. But the UK has also introduced the Bribery Act, which applies basically to any business which has even got a single UK employee. It applies across the board to all of the businesses' worldwide operations. And again, it's important in this current environment where the BRIC countries' economies are certainly still expanding, and where therefore sales opportunities may be greater for many types of businesses, that employees are well aware of your internal policies on bribery and corruption, that there is an open culture, an open whistleblowing culture, that whistleblowers who are genuine whistleblowers are not victimized, and that the company can then show that even if an event happened that was inappropriate, it had the right policies and procedures and it dealt with the matter in the right way as soon as it became aware. Data privacy has long been an issue in Europe, but recently the data privacy rules were tightened so that a data privacy breach arising from a data security breach is an issue. It is also an issue these days and needs to be factored into internal communication policies here in the US, because there are certain things that US employees, when they communicate with each other, can freely do, which they cannot do when they're communicating with their European counterparts. So, for example, if you're sending any data that is sensitive or personal to a European counterpart, it is very important that the data is password locked and protected and not referred to openly in an open email. So it is important that these kind of issues are considered when you are reworking your internal communications policy in your business. In addition, outside of Europe, India now has data privacy regulations but they are limited to Indian employees. So they don't cover BPO type data relating to foreign employees whose data are being processed in India. They relate to the data of Indian employees within India. There are a number of other countries such as Hungary, Mexico, Russia, and South Korea that are coming out with regulations. Unfortunately, all of these regulations are different from each other, and there seems to be no move afoot to set a uniform international standard, which is going to become a big problem for companies that have multi-country operations in the future. I've mentioned the competition laws of the EU, but these only apply to very large enterprises and multinationals, but I put it there for the record. The next slide looks at now a different stage in the life of an international company where it's got mature operations abroad. It may have foreign profit centers, and it wants to repatriate its profits back home to the US where the parent company is based. Netherlands has got two major advantages within Europe. It's got tax treaties with a lot of countries, including countries with which the US does not have tax treaties, like Taiwan, for example. And of course, it also has great advantages when it comes to importing goods, the VAT cash flow advantages thereon. I'm not going to look at the VAT issue in this presentation, but we can cover it in any questions if you want. The main exemptions from a tax point of view, as opposed to a VAT point of view, are that there is no tax on dividends that are received at the holdco level. Neither is there any tax on capital gains at a holdco level. There is a reduced or zero rate of dividends when the holdco distributes up to the U.S. shareholder. And in particular, the holdco, instead of being a BV, is a co-op. The non-resident taxpayer members of the co-op are not taxed in the Netherlands. There is at the moment no specific requirement in the Netherlands as such to show substance. In other words, to show that the Netherlands co-op or BV is independently operated and run from the US. But there may well be such a requirement coming from the US end, in that the IRS is becoming a lot more active in following up on these schemes and demanding proof that where there is such a holdco availing of these tax exemptions, that it genuinely is run and operated quite independently from the US. In order to do that, it needs to have Netherlands resident directors. It can have US directors as well, but it needs to show that the Netherlands resident directors are the executive directors and have full powers of running that business, operating its bank accounts, etc., exactly as it would if it were a semi-autonomous business. The next topic I thought I would flag up, because I've often been asked this question, is how do I get my profits out of China? The answer is that you can get your profits out of China, but you need to be very careful about how you do it, and you need to plan for it right at the start when you set up your Chinese operation. If you don't, you could easily basically corner yourself into a position where it becomes difficult to get the money out. So, for example, the type of services that are going to be offered in China, the way in which you're going to invoice your customers, the relationship between the Chinese company and its parent need to be consistent and need to be reflected in the articles, and also be consistent through all of the intercompany agreement and other paperwork that would be supporting the infrastructure of the company once it's set up. There are basically 5 ways of getting money out, having said that. One is through a dividend. Second is through an interest payment, but you have to be aware and beware, rather, of thin capitalization issues. You can get it out through a royalty fee. You can get it out through a service fee, but the service tax on that fee cannot then be recovered. Or you can get it out through a cost-sharing arrangement. Essentially, where this is happening, non-resident companies, i.e. the parent of the Chinese company, will generally need to register for tax purposes. And the Chinese tend to, very much actually as we do in the US, tend to differentiate between active and passive income. So I've kind of defined at the bottom of the slide in kind of simple way what the definitions are. Active income would be income generated from overt business activity, like project work, provision of services or goods of that type. Passive income would be income that you earn without actually having to work for it, in the sense that it will be income from dividends paid up to the Chinese WFOE if it has any subsidiaries anywhere, interest income, rental income if it owns property, royalty income, or gains if it makes any from property transfers. For each of these types of income, before you can get the money out, even after you have this infrastructure that will enable you to do it, there is a large bureaucracy and a number of government notifications that you need to go make before you can get the money out. And I've given you a list of these in the next slide for a general kind of flavor. Basically, a whole load of information on the identity and the residency certificate of the company that's receiving the dividend, Forex-related certificates, board resolutions, certificates saying that the company is basically in good standing and has paid all the taxes owed. This is the Chinese company, credit reports on the Chinese company, and a whole host of other supporting documents that are too long a list to actually put here. So just be aware, it can be done, but it's a lengthy, time-consuming, and bureaucratic process. I now move on to the last topic here in my presentation, which is directors' personal liabilities. It's a very wide topic, and I've just taken 5 countries here as an example. In China, one of the biggest risks that directors of Chinese subsidiaries of foreign companies run is being prosecuted for infringing the IP of a Chinese company. In principle, doing that can result in a death sentence on the director, not just a criminal charge, but you could face the death penalty. Whereas if a Chinese company came and stole your IP, the director of the domestic Chinese company that did it would not face a similar risk. So it's kind of like the law is a bit warped and one-sided. And so you need to be very careful that when you're operating in China, you're not trampling on anybody else's IP rights. In Australia, an Australia resident director is, or indeed any director, but the resident director is the fall guy, and you have to have a resident director in Australia. He's required to show that he has kept proper books and records, and a failure to do that is a criminal offense. Canada, on the other hand, is very focused on the environment, which I think is understandable given how beautiful the Canadian countryside is, I guess. And environmental offenses lead to heavy exposures. In the case of Japan, Japan has a civil code, and just like Australia has a requirement for a local resident director who is effectively the fall guy, breaches of the Japanese civil code, in particular failure to keep proper books and records and failure to file and pay accurate taxes, is potentially a criminal offense, particularly if it can be shown that it's willful. The UK, on the other hand, is very focused on anti-bribery and data privacy, and breaching data privacy rules by, for example, running a UK payroll without registering with the Information Commissioner is a criminal offense in the UK by the directors of the UK company. So ladies and gentlemen, I hope I haven't bored you to tears with this whistle-stop tour of setting up operations abroad. It's a very broad topic, and happy to take any questions you have at the end of this presentation. I would like to hand over now to Ken, because I think Ken's perspective, which is very much that of which will be very much that of your type of perspective as opposed to mine, where I'm used to servicing needs of people like you. Ken's perspective will be extremely valuable. Ken, over to you.
Thanks, Sean. Well, after that last slide, I think I want to retire as of 5 o'clock today and never practice as a CFO internationally again, because I didn't realize I was signing up for the potential of criminal liability or the death penalty. I always thought the worst thing that could happen is I'd lose my job. We should be on a slide now entitled CFO's Perspective. And let me start with a big picture issue, which is, as a CFO, I see my job as supporting the business needs of the company. And therefore, all of the issues that I'm going to discuss today really follow rather than lead any decision to do business internationally. At the end of the day, we, Black Duck, or any of the companies that I've worked for, make the decision to go into an international market because of market opportunity, market need, the needs of our customers in other countries. And so as much as there are legal, accounting, HR, language, tax, and all sorts of other issues that we, the CFO, have to deal with, at the end of the day, those decisions don't drive whether or not we're going to choose to do business in a particular country. And I say that because the reality is that oftentimes the CFO is told, okay, we're going to do business in country X, Y, or Z, figure out how to make it happen. And as someone who's been doing this for 31 years at 8 different companies and has worked with Nair Co several times, I can tell you that oftentimes you're not given a lot of notice before you're having to deal with these issues, which is why getting the expertise of a third party like Nair Co certainly helps. So let me start with the thing that is always first on my mind when we go to another country, and that is the legal considerations. And it's not only with regard to branch versus subsidiary, but it's the legal system in that country. Those of us who have been born and raised and done most of our business from the United States tend to take what I call an American-centric view of the world. We tend to think our system of laws is the best and the one that should prevail. But realistically, the United States is only a couple of hundred years old, whereas when you go to certain other countries, they have potentially thousands of years of history and a legal system that may, instead of being based on contract law, be based on Napoleonic code. And so recognizing that our system of laws may not govern when you're doing business abroad means that you have to educate yourself as to what are the customs and norms in the countries that you're working. Not only is it the legal system for how you're operating in that country, but to the extent that you're doing business with customers in country, there's the question of choice of law in a contract. So I may be an American company doing business with a Chinese company, and we're going to have a debate as to whether or not the contract is going to be governed under Chinese law or under U.S. law, or perhaps under UK law as a neutral location. With regard to dispute resolution, at some point, every contract may be subject to some level of dispute. And the mechanism for arbitration or mediation or how things are going to get resolved is often very difficult. Again, you've got time, you've got distance. If you're an American company doing business abroad, the challenge of having to be governed by a foreign set of laws is one thing. The challenge of saying that disputes will be resolved in that foreign location may mean that you, as the CFO and other members of the management team, may have to get on a plane to go to another country to resolve a business dispute. Moving on to accounting and tax considerations, again, we've been spoiled in the U.S. to have, for the most part of our careers, deal with U.S. GAAP. Everyone's aware of the move towards IFRS, which has existed elsewhere in the world, and really in the United States we've been the last to the party. But you still have an issue with regard to local reporting because as a U.S.-based company you may have to report under U.S. GAAP. Your subsidiary branch or other business entity, joint venture or whatever, may produce their financial statements under IFRS. And it's like learning another language to make sure that you understand how do I translate my financial statements into something that I can consolidate into my corporate consolidated numbers. Tax issues, VAT, income tax, other taxes, a whole host of things that in many instances we're ill-prepared for. Having to deal with multi-state issues in the U.S. with regard to sales tax is problematic enough, but with regard to VAT, income taxes, and other taxes, withholding issues, in some instances, the amount of work that you have to do with regard to compliance can be overwhelming, and you look at it and say, from a cost-benefit perspective, you may not be able to justify it, or in some instances you may say, I'm not going to file for taxes locally, but what that's going to mean is I'm going to be subject to a certain amount of withholding, which I'm never going to get back, which becomes, in my way of thinking about it, a frictional cost of doing business in certain countries where taxes are withheld that you can't get back. And then there are the issues of the local norms. How are things done in country? Every country, every jurisdiction has its own local norms that, again, if you think you've seen it in one country, it's going to be different in another country. Sean talked about a lot of these issues, and that only is the tip of the iceberg. And as someone who's done business in probably 30 different countries, my perspective is that it's pretty scary because of the issues that you will face without being forewarned and forearmed. As a CFO, I've always been responsible for not only accounting and legal, but also human resources. And there's a whole host of issues as an American country doing business abroad, starting with attracting and retaining employees. While some employees will see that as a positive, an opportunity to work for an American company, others will see it as a negative. And trying to make yourself attractive in a foreign jurisdiction, in many instances, the issue of the fact that you may have a very small employee base in a particular country makes it even more difficult. And I'll talk a little bit more about the time and distance issues in a minute. But probably the most challenging, and Sean, as I say, just hit this at a very high level, some of the issues with regard to hiring and firing. I've had too many instances where I've had an employee who may not be working out. We have agreed to part ways, but the government has intervened and said, well, that's fine that you and the employee have agreed to part ways, but we, the government, are not going to let you out of it that easily. And it's not even a question of money. You can find that you are responsible for paying that employee not only for a long period of time, but also, for instance, if they're a commissioned salesperson, for paying them ongoing commissions even after they've departed. Moving on to the next section, treasury issues. Currency issues are a whole another set of problems with regard to payment standards. We, as a company, try to, anytime we can, get paid in U.S. dollars, but certain companies will insist on paying you in their local currency. And, of course, you then take into your accounting issues the risks of foreign currency translation, currency gains and loss, whether or not to get into currency hedging, and all sorts of issues. And for small to medium-sized companies in particular, chances are you probably do not have a treasury function. The CFO is often the treasurer as well as the corporate secretary and filling other roles. And having to deal with these means that you're going to have a bank who is facile in helping you to manage foreign currency risks. And Sean already talked about the issue of repatriation of funds. To the extent that you're wildly successful in a country, you've created a business that is making money, and you want to get that money back, you may find that that's going to be very difficult. And so when you make the decision to enter a country, you may not find that leaving the country either while you're still operating or when you shut down the operation. And that's something that most people don't think about, is what if I go to a country and I find I don't want to stay there? You may not have a choice. You may not be able to get your invested capital out. You may be able to get your invested capital out, but it may take some time. From a customer perspective, I said before that oftentimes you make the decision to go to a country because of where your customers are or because of market opportunity. But there's also the challenge of, for your customer, both good and bad, dealing with a non-domestic provider. So in some instances, it's good because to the extent that you have a local presence, they're going to be happy that you actually have people on the ground in that country as opposed to one of your competitors who may have to fly in to service them. On the other hand, if you're competing against local providers, you as a non-local provider, irrespective of your local presence, may have some challenges. And as a CFO, these are things I worry about, even though it may not ultimately be my area of responsibility. One of the most important things that I've learned doing business internationally is to recognize the cultural differences. You don't necessarily bridge that barrier just by sending a T-shirt with your company logo to your new employees in a foreign country and assume that they are going to sing in the same chorus with your employees who are based here in the United States. And so you have all sorts of challenges. The fact that they may not see people from the home office that often, the fact that they may feel isolated. What I said before about the American-centric view of the world, where we have to be very careful to recognize that other cultures have their strengths and weaknesses just as we have our strengths and weaknesses. And many people tend to perceive Americans as being abrasive, aggressive, or in some cases even obnoxious. Time zone. It's very easy to say, I live on the East Coast. All meetings should be held between 9 a.m. and 5 p.m. according to my watch. But if you're doing business 12 hours away, 6 hours away, 13 hours away, oftentimes you have to think about the fact that the person who you want to get on a conference call or participate in a Skype meeting may be middle of their night, their dinner time, their breakfast time. And so one of the things that I've tried to do is really switch things up between meeting times so that occasionally the meeting may be in the middle of my night instead of in the middle of my employee's night, who is halfway around the world, recognizing that just trying to get everybody together on a conference call is sometimes a big challenge, but it's something that you have to be sensitive to. The operational considerations in terms of if you sell a product that is sold with markings in English, with the instruction manual in English. In my case, we're a software company where our software operates in English. The issues of if you do sell software, whether or not it's single byte or double byte enabled, the costs of localizing or internationalizing your products, goods, or services to the markets that you're serving. Many people don't make the choice or make the investment to localize or internationalize, but it's something you have to think about, and you have to consider what the impact will be. And you have to recognize that things just work differently in different countries. And so while you may have one business model in the U.S., that may not work in other countries. The technical issues with regard to connectivity, with issues like bandwidth, issues like can I get all of my employees on a cell phone plan that will work across all European countries, not just one country. Back to the issues of language. We buy computers here in the United States, but we can't get in the United States a keyboard with a French language or German language set on it. So we may have to buy certain technology purchases in country, which adds to the complexity. Finishing up with regard to the logistical issues, one of the most important things is the challenge of how do I get people where they need to be when they need to be there. The costs of travel, the toll it takes on your employees to be traveling internationally. My last slide, I'm a big believer in what I call MBWA, management by walking around. It's critically important if you have international operations to be on a plane visiting them on a regular basis. It's critically important that you show the flag. It's critically important that you bring people from your international operations back home every once in a while. You can't do everything via Skype. You can't do everything via webinar, a conference call, video chat. And it adds to the cost and complexity, but if you don't have the face-to-face, you'll find that you will fail. And my parting words will be, you don't know what you don't know. I've done business internationally for the better part of my career. I've done business in 30 different countries, and I know a lot. I know I don't know a lot, and I have a healthy respect for what I don't know. And I also recognize that if Murphy's Law is a risk to me in the U.S., it's an even greater risk when I'm doing business internationally. And with that, I will turn it back over to our moderator to finish up.
Well, thank you very much, Ken, and thank you very much, Sean, as well. We've heard Ken's perspective, a senior finance leader's perspective, a CFO's perspective. We want to hear your perspective as well. So we're going to pose the first of two poll questions. And the first of these questions asks, which of the following do you view as the top opportunity, from your point of view, for global expansion covering this year through, say, 2014? And feel free to select what you believe is you perceive as your top opportunity. Choices are India, China, Latin America, Europe, Middle East, or if none of the above apply, but there is a location you're thinking about, feel free to select other. And what we will now do is reveal how attendees have responded. And so far, we have seen among respondents to this question, Latin America seems to be winning so far, and then Europe followed by India, China. Wanted to get your perspective, Ken and Sean. Have you found similar distributions of responses when you've considered this question?
Sean, why don't you go first?
Okay. I think that the answer is yes, but I think it's also pretty time sensitive in that the kind of feedback that I'm getting in the last 2 months is quite different to the feedback that I was getting in the previous 10 months. I think the first point is that although we all hear that Europe is in dire straits, the fact is that it is a major market for American goods and services. And there is really no reduction that we see that much in the appetite for U.S. companies to sell into Europe. If anything, many of our clients are expanding rapidly within Europe and selling more, not less. So that's a strange dichotomy, because on the one hand, we hear the Europeans are in a bad way, and yet they're selling more, as otherwise our clients wouldn't be attempting to sell more. The second observation is that while China used to be the blue-eyed country of the BRICS, China's economy is contracting at a fairly high speed, or rather the rate of growth is declining at a fairly high speed. It is not contracting, it's expanding. India's is also reduced, but at a lower level. And so we are seeing more interest in companies wanting to enter the Indian market than the Chinese market in the last 2 months, whereas it was exactly the opposite 10 months ago. Latin America has always remained fairly stable. I've seen a lot of interest in Brazil and Mexico. In Brazil, it could be because it's a very difficult country to operate in from an accounting and compliance standpoint. So I could be seeing a biased cut of the market. In other words, I could be seeing many companies wanting help there because it's such a difficult place, as opposed to because many companies actually go there. But oddly enough, I also see quite a lot of interest in companies selling into Argentina, despite some of the problems that the Argentine economy has been having lately. That's my 10 cents worth. Ken, over to you.
So interestingly enough, India, China, Latin America, and Europe are all the areas where we focus. But what Sean just said in terms of other areas are also areas that we're looking to expand our presence. Today we do business in 24 different countries, but as the bars indicate, I would probably rank it. Europe is our biggest market, followed by India, China, elsewhere in Asia. Latin America is probably the one that shows the greatest promise in terms of future growth, although it's also, as Sean said, one of the more challenging areas.
Well, thank you, Ken and Sean. And this leads to our second of our poll questions for attendees. What do you view, again, top choice here, in this case, top risk, when expanding across borders? And here are some choices to consider. Feel free to indicate what you believe to be the top risk. Choices are local country compliance issues, currency exposures, employee contracts and productivity, data privacy, intellectual property protection, and also very important, communication between the home office and the international operations. And so far, what we can see among attendees of this webcast who are responding to this question, we see that so far a majority have indicated local country compliance issues seems to be the greatest challenge. But what I am curious about from Sean and then Ken, likewise, have you experienced this, or Sean, in your case, have you seen clients perceive that local country compliance issues are their leading issues, or are there other issues that you've seen predominate as well?
I think that obviously the audience is mainly accountants, so they would be worried about compliance, and I can well understand why local country compliance is sitting there, because it is a nightmare if you're sitting in the U.S. To even know what all your compliance requirements are, leave alone make sure that your entities are in good standing. And quite frankly, if that wasn't a problem, then my firm and I wouldn't be in business. But if you look at the business risks as a whole and look at it as a businessman, I would have said that IP protection is my top worry, because I want to make sure that my technology doesn't get stolen, doesn't get copied, and cheap reproductions all over the place in places like India and China. And particularly in China, where my ability to protect my IP is limited, would be a big concern for me and a big inhibitor by doing anything that might cause me to reveal some of my IP to my Chinese operations. So I would have said IP number one from a total business perspective. Then I would have said communication between the home office and the international operations and data privacy. I would lump them together because the data privacy issues need to be factored into the communication policies. And I see very, very few American companies have cottoned on to that and are actually doing anything about it. The employee contracts and productivity, the currency exposures and compliance, these are all process-type issues, which if you have good documentation and take good advice at the start, you can reduce to a de minimis level and are generally not that much of a worry.
Thank you, Sean. And what perspective would you want to bring as well, Ken?
I'm going to keep my answer pretty short. The reality is all of these are good issues to raise because we're actually in the business of helping people with intellectual property protection. I'm somewhat prejudiced in my answers, and also with regard to data privacy. I will say compliance is an issue for me. Currency exposure is towards the bottom of the list. Employee contracts and productivity is something I worry about. Intellectual property protection. We both help companies, but we also have our own IP to protect. And I already stated that communications between home office and international operations is a great challenge because email just doesn't do it. Even telephone, Skype, video chat, it all isn't the same as face-to-face. So once again, every time I follow Sean, all I can say is, yes, I agree with what Sean says.
Well, with that in mind, this is a good opportunity to address questions. We've got a number of great questions from attendees. One question, this is a very general question, when entering international markets for the first time ever. And this is granted a general question. I'll direct it to you, Sean. How much time do you need to prepare to enter the market from a financial and accounting perspective? I recognize this is a broad question, but Sean, how would you respond if someone were to pose that question to you?
Basically, if it's not China, approximately 6 weeks, 6 to 8 weeks. If it's China, depending on what the setup there, 6 to 8 weeks or 4 months. That's a straight answer to that question. And that's because you ideally need to determine what type of entity or registration you have to have in place, and then you need to set it up. There are certain countries, like Singapore and Hong Kong, where you can cut that time period right down to a week. You can even cut it down to 2 days if you have all the documents. But generally, it will be between 4 weeks and 8 weeks for most countries and types of registrations, with a few exceptions. A subsidiary in China being one, a limitada in Brazil being another.
So the one thing Sean didn't talk about is oftentimes you don't make an explicit plan to go into a country. You end up in a country either accidentally or intentionally by somebody else's choice, meaning your customer has taken you into a country with them, or you find that one of your salespeople has done a deal in a country that you have no business being in, and then you have to figure out after the fact. I would agree if I have my druthers, I'd like 3 to 4 months to prepare to enter any country, but all too often I've found out that we're doing business in a country, now I have to make it work.
Absolutely, absolutely. Well, thank you. Thank you both. And we have time for a number of other questions as well. So one attendee asks about actually several attendees have asked about repatriating profits from India, from China, from Brazil. Generally speaking, given that we've had several attendees have posed the question, what are some best practices with addressing questions that you've received, Sean, especially as they relate to repatriating profits from China, India, and Brazil in particular?
Okay, basically the hardest one is China. The easiest one is India. But when I say easy, it's all relative. In India, basically, before you can repatriate the profits, as an example, you have to get Reserve Bank of India, RBI permission. And in order to get RBI permission, you have to have a chartered accountant certificate for, and obviously all of the appropriate paperwork. So there is a kind of well-structured process that you have to go through, which will take time. So you don't want to keep repatriating your profits frequently. You want to do it maybe once every year or even once every 2-3 years. But the process is quite straightforward. There are tax withholdings, which you may not be able to get back. And those tax withholdings also depend on the revenue streams that have built up the reserves. But it's a pretty structured process and it can be done. In the case of China, it's a large bureaucracy, as I mentioned. In the case of Brazil, I would say it's somewhere in between. It's not as complex as China, but it is more complicated than India. That's a very general answer, and obviously I can give more detail offline if required.
Thank you very much. And Ken, just summarizing your experience as well, have you seen similar? Have you had a similar experience to what Sean has described?
Yes, and I'll leave it at that.
Okay, that's fine. That's fine. So here's an interesting question from an attendee. What difficulties, if any, is there in setting up a banking relationship, subsidiary versus branch, to follow up, Sean, on your earlier discussion?
Sorry, I didn't follow that question fully.
Oh, no problem. Attendee asks, what difficulties are there, if any, in setting up a banking relationship? And the attendee was asking subsidiary versus branch, and I gather this is a relationship involving a an overseas location. I think this follows up on your discussion about the subsidiary versus branch scenario.
Yeah, I don't think the banking relation, the setting up of the bank account for either of those two types of registrations is going to be different. The main issue you've got is that the bank that you've chosen in the local country for the bank account will need to go through a set of anti-money laundering procedures to establish your authenticity. And essentially, typically these banks have two departments. They have the initial department that processes your application. And then, in principle, that department gives its approval. And then the paperwork has to go to the bank's internal audit department. The bank's internal audit department can ask a whole host of additional questions. And they can sometimes be quite easy, sometimes be quite difficult. Essentially, one way of shortcutting it is if you are already have a banking relationship in the U.S. with a bank which has got branches abroad, you could shortcut it. Alternatively, if you have a relationship with a bank which has got very good and close correspondent relationships with other banks, then again you can shortcut the process. One further exception is Switzerland. A lot of Swiss banks these days, after the troubles that UBS have had, are turning down applications from Swiss subsidiaries of U.S. companies to open bank accounts because they don't want, they've basically taken a decision that they don't want U.S.-centric business. It's not an acute problem. There are banks in Switzerland where obviously you can bank, but the choice has now become more limited than it used to be.
Thank you, Sean. We have time for maybe just a few more questions. One question is, attendee asks about converting an entire company to IFRS to eliminate the need to convert between and among local gaps. Sean, how would you address that question?
I think I think that's a good point, and I think Ken would probably have a better perspective on it than me because I'm not a U.S. expert. But there are still certain countries abroad where IFRS is still not the norm, and where there are local regulations. And a good example of that is China, where you have to keep management accounts in a particular format in Mandarin. So it's not quite the panacea one would think, but I think, Ken, you may have a better perspective on this than me.
Yeah, once again, I agree that while I love the concept of going to one set of universal standards, I don't think that we're ready for it, and we've been hearing about U.S. adoption of IFRS for a while, but it hasn't taken place just yet. So I think it would be premature for a company to say, okay, we're going to go to IFRS to get ahead of the curve, because you may find that you have issues with investors and with banks getting there too soon.
Thank you, Ken. I think we have time for just a few more questions, and then we will wrap up. An attendee asks, let's say there is an employee of a service provider. The service provider is located overseas. Is there a risk that the employee who works with the overseas service provider could claim some additional benefit, perhaps from the home country where he or she is located, in relationship to the putative employer, for example?
Okay. No, with the exception that if it is some kind of a PEO arrangement, say the employee is working for a temping agency but is being engaged by you through that temping agency to provide you with support. If that's happening in Europe, the European employment law has the concept, as I mentioned, of deemed employment. So both the temping agency and the company's local operations would be jointly and severally liable from an employment law perspective. That one exception, the answer is no, but in that case, the answer is yes.
Well, thank you very much, Sean. Thank you very much, Ken, as well. On behalf of our distinguished guest speakers, Dr. Sean Nair, who is the co-founder of Nair & Company, and Ken Goldman, Executive Vice President and Chief Financial Officer with Black Duck Software, we all very much appreciate your joining us for our webcast, What Finance Leaders Need to Know About Expanding Operations Overseas, brought to you by CFO Publishing and by the sponsor of our webcast, Nair & Company. We thank you for your time, and we hope you enjoy the rest of your day.